I do want to point out, we've argued for a while so far, the market has pushed back on this. Again, the concern would be if we were to take out some of these key levels, 4, 5, inch our way back to 5, would we be able to stomach those higher levels? Let's ask that of our next guest. Wayne Kaufman joins us to help us take a look at the fundamentals behind the technicals. He's Chief Market Analyst at Phoenix Financial Services. Wayne, good morning to you. Thanks for sharing part of your Monday. Good morning. I want to talk 10-year at 4.3 to begin the week as some of those recent rate cut expectations continue to get pushed further back.
Well, I think you hit the nail right on the head relative to the expectations, because we saw at the end of the month, we saw rates coming down, and then when we had the PPI and the CPI, they shot back up. They completely erased that move down, and now they've rebounded back near that resistance, which you've pointed out. And the Fed hiking cycle began 2 years ago, and the bottom line is inflation remains very sticky. There is no chance of a cut this week, probably not in May. June, a possibility. And to highlight how difficult it's been to figure out the whole inflation picture, Janet Yellen recently admitted to being wrong on inflation, and she said that rates are not going back to pre-COVID levels. So how often do you see a government bureaucrat admitting to being completely wrong? They never do that. So inflation is sticky, and yeah, we have a bunch of central banks this week. But I think everything you said about the 10-year and the possibility for it going higher, very, very true, because if you look at the daily and the weekly charts, the 10-year yield is nowhere near at an overbought level, which if it was overbought near resistance, then you'd think it might pause. But there's definitely the possibility of breaking through that resistance. Yeah,
Janet Yellen saying that she regrets saying that inflation would be transitory. It has come down, she said, but she said she thinks that transitory means a few weeks or months to most people. Obviously, it has, to your point, been a bit more stubborn and a bit more entrenched than we initially thought it was going to be, it seems like. Talk to us. Is this something that the stock bulls can continue to stomach, right? Because obviously with the S&Ps here at 52.25 or just shy thereof, I mean, we're holding on to these levels with the 10-year above 4.25. Where's that line in the sand come? I mean, we've been arguing for a while. It's not so much rate cuts. It's just expectations that peak has been met, right? That we've already seen peak. So we can stomach higher rates for longer. But what if we start to get whisper, or what if we start to hear talk of, hey, the Fed might have to get a bit more aggressive here, Wayne?
Yeah, that would definitely be interesting. So, the last time I was on, I said I was expecting a correction. I was bullish, but I was expecting a correction. And we have not seen anything approaching a correction.
Not at all.
In fact, we're on a streak where the S&P hasn't even pulled back 2% or so. It's in over a year, hasn't seen a 2% one-day drop. In fact, in the last 96 days or so, we haven't even seen a 2% drop from a daily high to a low. So the market's just been grinding higher, and it has broadened out. But when you look at what's happened here in March, the S&P by itself has not really been that strong. And we've seen some sector rotation. Energy is up 6.2%. Month to date. Materials up 3.5%. Before today, the S&P itself was only up about 0.4%. So it's definitely affecting what's going on. And the good news is a couple of pieces of good news. I was very bullish in my last interview that was on 2/6 regarding NVIDIA, which I spoke about the AI complex really driving the market. And I said at the time that NVIDIA actually seemed cheaper than it previously had been in spite of that move up. And the stock then was at 693 and obviously considerably higher today. So this week, the big things I'm looking at this week, obviously the Fed, but also the NVIDIA conference, which which you mentioned, and Micron Tech with their earnings. That's going to be extremely important because
Micron's we're going to talk about that in just a couple minutes. Yeah.
Yeah, they're involved with this high bandwidth memory, and that's a major element in the AI thing. So between NVIDIA's conference with Micron Tech, it's a possibility that we can sustain what's going on in the AI group, and but of course the interest rates. Obviously, it's a big deal, and then energy.
Well, wait, Wayne, before you get into energy, I did want to talk one more quick thought here, quickly, a chart. Wayne mentioned the rally we've seen throughout the month of March. We started off the show, Wayne, talking about this chart and some of the gains up to 52, 53 in the S&Ps here. Wayne, I guess one of the questions I have before we talk energies is, here's the daily chart, right? And the move off the October last year lows, October 2022 lows. But Wayne, how much of this has been the U.S. dollar, right? Because we talk about all these contributing factors here, NVIDIA, the AI rally, the broadening aspect of some of the other names now participating. But the dollar has been weakening throughout all this. Yields on the move higher. Dollar now, we're starting the week off below 103.
Yeah, so the dollar is to me, it looks relatively steady. It's gone up, it's gone down over a period of time. But if you look at the longer-term chart on the dollar, it hasn't really moved that much. And yeah, it is right now under its 20, 50, and 200-day averages, but just under. If I can back up for just 1 second onto S&P, part of the reason for stocks holding up the way they have, earnings have been just tremendous.
Yeah.
Earnings season has been phenomenal.
Yeah.
Earnings growth year over year is about 8.2%. We came in to the season looking for a 1.2% gain, and we usually beat it by 3%, sometimes 4%. Even with that, an 8.2 over, say, a 4 or a 5, really, really strong. And I think that's been a major factor in holding this up.
The economy has been strong, employment, right? The consumer, and we're seeing that as you were about to touch on there. I'm sorry I had to interrupt you because I wanted to kind of get your thoughts on the dollar there, because dollar's been a little bit lower here, rates have been higher. I've been sort of wondering maybe that's been balancing things out for the stock bulls, but a bit of a headwind for the stock bulls, as I was arguing in my newsletter this morning, is crude oil starting off this week above 81, but it also kind of ties into strong demand, economic conditions here in the U.S. and pushing back on some of those recession expectations.
Yeah. So, relative to the consumer, I think there's questions about the consumer. The retail sales number for February was not as strong as expected. And we've got, and it is an important point that you've got energy prices moving up. So that's going to actually make it even harder for the Fed to come in with cuts. Gasoline prices have been moving up. They're still way below the highs that they've hit in recent years, but they're moving up. And the question is oil moving up because of demand so much, or is it more a supply thing? The International Energy Agency came out and they said that they're expecting demand to exceed supply.
Yeah, I saw that last week.
Because of OPEC cuts.
Yeah.
And this week there's also a conference nobody's talking about, something called CERAWeek, which is the world's biggest energy conference. So I think we're going to get a lot of color on what big energy companies really think the future is going to look like. But the other thing is, though, I think we can handle oil moving up certainly into the 80s, on an inflation-adjusted basis. It's not really that high. We are seeing some movement in commodities, copper breaking out, gold making all-time highs, crude oil, of course.
You're giving us a perfect segue into our next segment here, Wayne, because we're going to be talking commodities in just a minute, but I would argue this week the focus here primarily on some of the financial products here. And, we could continue this conversation, I feel like, for the rest of the show. We could break it down individually, talk yen, pound. I was reading about how the Swiss National Bank ultimately could be the first to actually cut here now. So definitely the focus here, again, I feel like on financials. We're going to dive into the commodities in just a second. But, hey, Wayne, appreciate you joining us here and helping us talk about the week ahead here. And, again, multiple focal points here and kind of tying it into the rally we've seen in stocks. Wayne Kaufman, Chief Market Analyst at Phoenix Financial Services. Always thanks to Wayne.